Hi, I'm Steve Shaw, founder of Bondsavvy. The reason why you're losing thousands by holding bonds to maturity is because of all the opportunities that you're missing out on compared to if you have a more active strategy where you're willing to sell bonds before maturity. So the first thing is that if you're holding bonds to maturity, you're never going to achieve a return that's higher than the bond's quoted yield to maturity when you buy the bond compared to if you sell it before maturity. You can lock in those capital gains. You're not going to achieve higher after-tax returns because all of your return, a significant part of your return is going to come from interest income, as opposed to having a greater portion of your return or a more significant portion of your return coming from capital gains, which is better tax treatment in the U.S. You're going to miss out on maximizing your compounded interest when you hold bonds to maturity because you're just going to receive interest off what your original investment is, compared to if you reinvest appreciated proceeds, you can increase your compounded interest. If you hold bonds to maturity, you're going to miss out on new opportunities. You're basically saying, all right, I make this investment today and I'm going to put my head in the sand for the next 10 years. And this investment is what it is. So you're going to miss out on new opportunities that may not be available today. And you're also going to miss out on minimizing the impact of inflation because, yes, you will get $1,000 per bond in 10 years or whenever the bond matures, but the present value of that bond is materially less than $1,000. So if we're able to have a more active investment strategy, we're able to mitigate some of the impacts of inflation, something you cannot do if you're just going to always hold bonds to maturity. Now, I think it's really important that we need to retire a lot of the ways that many folks think of bond investing, because what they'll do is they'll look at bonds that are available and they say, all right, 5.5%. And then they'll compare that to other investments, like they'll compare that to stocks, and they'll say, well, why would I ever invest in this bond if it's just going to pay me 5.5%? But if you have an active approach and you at times sell bonds before maturity, you can achieve returns materially higher than a bond's quoted purchase date yield to maturity. Lots of people just focus on tax equivalent yields when they're deciding between a muni bond and a corporate bond, but that's not the way to go. First, muni bonds and corporate bonds have completely different call terms. Muni bonds have extremely onerous call provisions, whereas investment grade corporate bonds are very favorable to the bondholder. In addition, because many investors just think of the yield to maturity, they're thinking, well, all I have to do is just calculate the tax equivalent yield, and then if that's higher than the yield of the corporate bond, then I'll just go with the muni. But that's not factoring in, well, there can be significant capital appreciation for a corporate bond, and it's more likely with a corporate bond because of the more favorable call provisions that corporate bonds have compared to munis. People will just create these bond ladders and think that, well, I'm just going to select bonds based on their maturity date. But that's the last thing you want to do. You want to look at bonds, everything that a bond has in terms of the financials of the issuing company, what the bond is yielding, all different sorts of factors, and what the value of that bond is relative to others, and make the decision not based on that, not just based on what the maturity date is. People will say, you know what, I only care about the coupon. And they don't think about, okay, well, how can we maximize total return? And they basically put bonds in a box. And last, there's this belief that it's really hard to transact when you're an individual investor buying and selling individual corporate bonds, and that couldn't be further from the truth. Maybe back in the 1980s, where a lot of those trades were done over the phone, it's now a fully electronic marketplace where you can get prices as good, if not better, than the world's largest investor. So it's really important that we kind of kick these to the curb. And when you just focus on these things and you're holding bonds to maturity, you're leaving money on the table, and also you're increasing the risk of your portfolio, because if you just assume that you're going to hold a bond to maturity, you're likely not updating your thinking on that particular bond, and that's when you have an opportunity for capital loss. All right. So before we get into the rationale for selling bonds before maturity, I wanted to give a case study. And this case study shows that importance. And it's a case study of a bond that Bondsavvy had previously recommended. It was earlier in our history. I founded the company back in 2017. I believe this was so this is for an eBay 4% due in July of 2042. And I'm going to explain what caused the changes in price, how we capitalized on that, and what would happen if you didn't capitalize on those changes in price. So what we show here is the dates that we of specific recommendations with respect to this eBay of 42 bond. So we first made the recommendation December 13th of 2017. We then, after the price had fallen, which I'll get into in a moment, we recommended people buy it again, our subscribers buy the bond again November 19th of 2018. We then recommended a sell on December 3rd of 2021. And you'll see the initial buy recommendation, it was at a price of 92.27. Then the bond had fallen down to 76.4, and then there was significant capital appreciation up to 115.27. So people who think, well, bonds are boring and there's no capital appreciation opportunity, you'll see from 76.40 to 115.27, that's about 50% capital appreciation. So why did that happen? The way to understand what caused a bond price to move is to look at the yield to maturity of the bond, of the corporate bond, and the two main components of it. And so we show a blue bar and an orange bar. The blue bar is what's called the benchmark US Treasury yield to maturity. And all that is just like this eBay bond is due in 2042, there's a US Treasury that's due right around July of 2042. On December 13th of 2017, that particular bond had a yield to maturity of 2.77%, as we show here in the blue bar. Now, the eBay 42 bond had a yield to maturity of 4.53%. So the difference between those is this orange bar, and that orange bar is called the credit spread. And all the credit spread is it's the extra compensation that a corporate bond investor gets above the quote-unquote risk-free rate of the U.S. Treasury. I would not call the U.S. Treasury rate risk-free. There's lots of risk associated with U.S. Treasuries, but it's showing you the extra compensation that you're getting, and it's quantifying in some ways the risk associated with that bond, though it's not always perfect. Okay, so on this date, it had this yield to maturity, and then it had the price of 92.27. Moving about a year forward, you had concerns about global growth. In Q4 of 2018, U.S. GDP growth was an anemic 0.6%, so trepidation around the U.S. economy. And what happened was you had, and there's a little bit of a flight to quality, you had Treasury yields increase, longer-term Treasuries yields increase. So it went from the U.S. Treasury due in 2042 went from 2.77% up to 3.33%, and the credit spread increased. So combined, the yield to maturity of this bond went up from 4.53% to 5.87%, which caused the bond to fall fairly significantly in price, down to 76.40. On that time, so this was when we made our first set of updated recommendations. We recommended Bondsavvy subscribers to buy this bond again at this price of 76.4. Now, a lot happened from then over the next few years. You obviously had COVID, and you had the Federal Reserve take extraordinary action. And by the time we got to 2021, you still had very low Treasury yields because they cut the Fed funds rate down to zero. But at this point, the 20-year Treasury was right around 1.77%, and credit spreads had fallen significantly. So that caused the bond's yield to maturity to shrink from 5.87% all the way down to 2.97%. And at that point, we said, all right, we've got really low Treasury yields, we've got really low credit spreads. There's not that much of an opportunity for this bond to appreciate further. The coupon was decent, but nothing out of the ordinary. So we decided to sell that bond on that date. When we look at the returns that we achieved, if you followed our recommendation on December 13th of 2017, you bought that bond at 92.27, then you sold when we made the sell recommendation, you would have achieved a total return of 42.16% compared to the iShares LQD corporate bond ETF of 25.21%, so significant, about 17 points worth of outperformance. It was over a 4-year period, so these were returns called about 10.5% per year. Had you followed our November 19th of 2018 recommendation, you would have achieved a total return of 66.80% compared to the iShares LQD ETF of 31.24. So call it about 35 points of outperformance. And over 3 years, you're looking at a little bit north of 22% a year. Now, again, that doesn't happen all the time, but it shows you what can happen. Had you instead didn't sell, so that's why we've got this in red. If you didn't sell, then you're now looking at a bond price of around 80. And the bond's yield to maturity is 5.94%. And this was driven by the fact that you had U.S. Treasury yields increase significantly because you had huge inflation. You had the Fed increase the Fed funds rate significantly, and that's what drove this higher. So if you were active, think about this from two perspectives, right? So the first is, and let's take the extremes. Let's take the November 19th of 18. You made this investment then. If you were to just hold that bond until maturity, until 2042, you would just, your return would be this 5.87% per year. But that assumes that the bond's going to go from 76.4 to par between November of 2018 to July of 2042. If you're able to achieve capital appreciation much faster than that, then your return increases significantly. And you're able to now, if you sold this bond, you can now earn interest income off the 115. So if you then redeploy that and bought more bonds, which is an example we're going to show you in a little while. If you didn't, then you're stuck here at 80. And it's not to say this will be a bad investment, but it's not as good as it could have been. And this was a mistake that we had made in a couple of bonds. We had recommended a couple of bonds in 2018, and the bonds, because you had a huge decline in U.S. Treasury yields, these bonds went through the roof. But there weren't that many compelling investment opportunities at that time, so we decided to hold the bonds. And those two bonds have done okay, but nowhere near what they could have done had we sold it, because 35 points is a big deal. Think about, and a lot of people will be like, I just care about the coupon. I just care about the coupon. But I believe that that's not optimizing your portfolio, because you've got 35 points here of loss, and it's going to take you a really long time to make that up. If you have questions, so we talked about credit spreads on the last slide. If you have questions, and at some point we'll create a video on credit spreads, but in the meantime, if you go to the Bondsavvy website, go to the Learn button on the menu, and from the drop down, click Corporate Bond FAQs, and then there's an article called "What is a Credit Spread and How Does It Impact Bond Prices?" So I point you over there. Okay. So if you're a dyed-in-the-wool hold-to-maturity investor, hold-to-maturity bond investor, I want you to ask yourself two questions. So first, if you buy a bond at 90 and it goes to 115, you know that the only rule that's in place is that at maturity, you're going to get par. So what's your rationale for holding that bond that has appreciated materially above par? You could get 115. Why are you holding out for par when you could reinvest those proceeds into more bonds and lock in your capital gain, increase your after-tax your after-tax return and maximize your compounded interest. And the next question is do you believe that there could be new compelling investment opportunities between now and maturity? Or is today the day? And I think you probably know the answer to both of those questions. What I want folks to do is to stop putting bonds in a box, and for folks to say, well, it's a bond, so all I care about is principal protection and income, meaning coupon income. Because when you stack up individual corporate bonds to bond funds and stocks, it's only individual corporate bonds that can achieve what I call the investing trifecta: income, principal protection, and capital appreciation opportunities. You can't do those with stocks, because stocks you've got low income, you've got minimal principal protection. With bond funds, you have no idea really what your income is because the distributions are variable. They don't have, there's no such thing as a coupon for a bond fund, and capital appreciation opportunities are very limited. And we've sold, so Bondsavvy, I founded Bondsavvy back in 2017. We've made nearly 170 corporate bond recommendations. I'm recording this in June 14th of 2026. And so we've exited 92 of those picks. Of those, 7 of them have been either called or tendered. 4 we held to maturity, and the other 81 we proactively sold. And it's important to have a flexible type of approach, because there could be cases where a bond is called. There could be shorter term bonds that you may decide to hold to maturity. And it's not, when we say that you're burning money by holding bonds to maturity, that's not for every bond, because there could be compelling bonds, especially shorter term bonds, that have a high coupon and that don't have capital appreciation opportunities, but have a solid coupon. And it does make sense to hold those bonds to maturity. So anything that we say here, it's not a one size fits all. But by and large, if you look at this proportion of the 92 exited recommendations, by and large, we're proactive sellers for the vast majority of them. If you want to look at our returns of all of our recommendations, you can go to the Bondsavvy website, click performance, and then you can see all of our past recommendations. If you look at the 92 exited recommendations, our median annual return of those picks was 9.16% compared to 6.37% for the iShares corporate bond ETFs. Again, past performance does not guarantee future results, but this is what we've achieved to date. The other point is that when you look at our total return, about 30% of that is from capital gain or loss. So to totally ignore that, and the thing is, like, that's pre-tax. If you look at it after tax, then that contribution is even more significant. So it's really important when you're investing in bonds to not just put them in a box and think of coupon income, but to also think of capital appreciation. The way that we do that is through an active investment approach. We update our picks every quarter up until the time we decide to ultimately sell a recommendation, with our goal being to maximize the total return of every bond that we recommend. Okay. So this is an example of a 20 bond investment, and we've given 2 scenarios. One is the investor held the bond to maturity, and the other is that the bond had 15 points of capital appreciation, and the investor, after 5 years, sold that bond, reinvested the appreciated proceeds into additional bonds. So we're going to show what the outcome was for these 2 investors. It's a very simple analysis. We're assuming 5% coupon, both the initial coupon as well as what the person who reinvested, what coupon he or she would reinvest at. Okay, So if we look at, and this is over 50, we're going to assume a 15-year time horizon, 1.5. This is the hold to maturity scenario. So day zero, 20 bond investment, we're assuming it's going to happen at par. So $20,000 gets invested, 5%. So that person's going to make $1,000 per year over the next 15 years. And then at maturity, the person's going to get $20,000 back. So these are the income streams, and as you would expect, $1,000 a year over 15 years, you're going to get $15,000. The other scenario is make the same $20,000 investment, but instead we're going to assume that the bond had appreciated in price to 115 at the end of year 5. So if price is at 115, if we sell 20 bonds, that results in proceeds of $23,000. We're going to then reinvest those proceeds. So rather than owning 20 bonds now we own 23 bonds, because again, we're still assuming that we're going to buy the bonds at par value. So you invest that $23,000, and now instead of earning $1,000 per year, you're now going to earn $1,150 per year. So when I say that an active approach can increase your compounded interest, this is what I mean by that. Because if you just held the bond to maturity, then you're just earning interest income off your initial investment. If you sell the bonds and it's appreciated, then you're going to earn interest income based on a larger number of bonds. So your interest income goes up, and since you capitalized on this $23,000, you sold that. Now, when you get paid back at maturity, you're going to get $23,000 instead of $20,000. So that results in total proceeds of $19,500, and incremental proceeds compared to the hold to maturity of $4,500. Now, again, this is just assuming at one point over this 15 years that you're going to have an opportunity to sell. We showed you in the eBay example that these things can be pretty volatile, and those opportunities happened over several years, and over 15 years, lots of different things can happen. So this 4,500 number could be materially larger than this. Now, a critic of this analysis will say, well, how can you assume? Well, what they'll say is, well, you achieved the 115, the 15% of capital appreciation because interest rates fell. And because interest rates fell, you're not going to be able to reinvest at the same coupon rate. And my response to that would be two different things. So first, the U.S. corporate bond universe is pretty big. There are 11,000 corporate bonds that are available on online platforms such as Fidelity.com. That includes about 10,000 investment grade CUSIPs, 1,000 high yield CUSIPs. So just because you achieved capital appreciation doesn't mean that all bonds went up. And so there can be opportunities in other bonds. The other thing is that you can be patient. We looked at the eBay example before, where you had huge capital appreciation. You had 50% capital appreciation over a small number of years. So you can afford to be patient. And what happened was that those bonds we sold in 2021, but then boom, in 2022, Treasury yields went up, and then there were all sorts of additional opportunities. So you can be patient. You don't have to, there could be a new investment opportunity that day, but even if there isn't, you've locked in your capital gain, and you then have an opportunity to be patient and find new opportunities. Because one of the reasons why we believe in investing over time, it's why we make new recommendations every quarter, it's why we update our recommendations every quarter, is because there will be new opportunities that weren't around when you first made an investment. Now, a lot of folks will say, hey, this all sounds good, but I'm just going to stay to bond funds because if you're a big investor, if you're like a PIMCO or a BlackRock, you're always going to get better prices than an individual investor. And that's another falsehood. And I came from the industry where the companies I worked for, they built bond trading technology. And those companies, as well as companies such as Fidelity and Schwab, have invested significantly on making bond investing very efficient for retail investors. And the best way to illustrate that is by showing the depth of book for an Apple bond. So this is Apple 4.65% due February 23rd of 2046. This depth of book was from fidelity.com, June 12th of 2026 at 5 p.m. Eastern Daylight Time. First thing that should be apparent is how competitive this marketplace is. So what we're showing here is these are all the different quotes that are being shown out on fidelity.com in this case. These quotes are being provided by banks, by broker-dealers, by trading firms, and the like. And they all want to transact. So they're providing, you see how competitive these are. So the best price was at 89.95, and the next best was 90.04, and the worst was 90.19. And the other fallacy is that you have to have this massive portfolio if you want to invest in bonds. That too is wrong, because it shows here what your minimum quantity was. So here your minimum quantity to get the best price was 2 bonds or $2,000 face value. So let's say you had $20,000 to invest. You could create a portfolio of 10 different CUSIPs of 2 bonds each at really good prices. When you look at the bid-ask spread, the best way to do that if you want to compare it to the institutional market is to look at it on a yield to maturity basis. So on the offer side, the yield to maturity of this particular quote was 5.49%. And on the bid side, it was 5.51%. The difference between those numbers is 0.02 percentage points, also known as 2 basis points. 2 basis point bid offer spread compares very favorably to the institutional market. It might be slightly lower in for certain bonds in the institutional market, but let's just say that an institutional investor might be able to get just a smidge of a better yield, because the person would get a smidge of a better price. That doesn't really matter, because if you think about all of the costs associated with investing through a bond fund, so first you have the expense ratio, but that's just really part of it, because there are also all these undisclosed transaction costs that they have, and they decide they don't disclose those. And when you've got a fund that has turnover that's significant, sometimes these funds can turn over 300%, 400%. That's significant. And so when you transact online and when you're buying an individual corporate bond, whether it be on Fidelity or another platform, and again, we have no legal affiliation with Fidelity, but I do use Fidelity, you get solid execution, you know what your trading costs are, and you know exactly what's in your portfolio. So you've got a competitive marketplace here. You can buy in small quantities. And so the notion that it's hard to sell or buy is false. It's a very efficient marketplace. So thank you so much for joining. Just to wrap up, of course, if you liked the video, be sure to give it a like and subscribe. This is generalized advice. This is based on our view of the corporate bond market. It does not pertain to your specific situation. Again, Bondsavvy has a different way of thinking about bonds. We don't believe in a lot of the traditional orthodoxy of holding bonds to maturity and just trying to get coupon income. There's a lot more that bonds can do, and we've shown how that can create really strong investment performance, which you can check out on bondsavvy.com.